In today's discussion, we dive deep into the current state of SoFi Stock, a name stirring significant conversations as we kick off the first trading day of 2025. While the broader market is basking in a green wave, especially among fintech and other growth sectors, SoFi is experiencing a different reality. What's causing this disparity? A meticulously orchestrated sell rating, strategically timed to disrupt the market and create panic-driven profits. Stay tuned as we unpack the details, debunk the flawed analysis behind this move, and explore why SoFi's future may be brighter than it appears amidst this turbulence. Hello everyone, welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But before that, alert, this is not a financial advice video. As the market opened today, SoFi stock was already under pressure, stemming from a sell rating that surfaced late last night during pre-market hours. This wasn't a random occurrence. It appears to be a carefully crafted plan to spread fear and drive profits for those betting against the stock. Over the last 72 hours, nearly a dozen major media outlets have echoed this downgrade, amplifying its impact. From Reuters to Barron's and Benzinga, the message has been broadcast far and wide, raising eyebrows about the true motives behind this campaign. What's striking is how flawed the analysis accompanying this sell rating is. The metrics used to evaluate SoFi are outdated and irrelevant, relying on legacy banking benchmarks that do not align with the company's growth trajectory. The downgrade was issued by KBW, a name that has become synonymous with targeted sell ratings aimed at specific stocks. It's worth noting that a similar downgrade was issued by the same firm almost exactly a year ago, showing a pattern of manipulation rather than objective analysis. To put this into perspective, let's break down the numbers and the logic, or lack thereof, behind this rating. KBW's analysis pegs SoFi at a mere 10x forward price-to-earnings (PE) ratio, which is significantly lower than the 15x PE multiple enjoyed by traditional banks like Bank of America. This discrepancy becomes even more baffling when you consider SoFi's projected earnings growth. Analysts anticipate SoFi's earnings per share (EPS) to jump from 15 cents in 2024 to as much as $1 by 2026, a staggering 500 to 600% increase. In contrast, legacy banks are growing at a snail's pace, yet they receive more favorable valuations. The question arises, why is SoFi, a company with such promising growth prospects, being treated as though it's stuck in the past? The answer lies in the motives of those behind the downgrade. It's likely that short sellers position themselves to profit from the ensuing panic, using this sell rating to manipulate the market. By flooding the media with headlines, they've managed to suppress SoFi's stock price by over 9% in just one day. Despite the immediate impact, this situation presents an opportunity for investors who believe in SoFi's long-term potential. The current sell-off lowers the stock's relative strength index (RSI), setting the stage for a strong rebound as the company moves closer to its Q4 earnings report, expected within the next 48 hours. Historical data suggests that SoFi has the ability to recover quickly from such events, and 2025 could very well be a breakout year for the company. Let's delve into the players behind this downgrade. The sell rating was issued by Tim Switzer of KBW, a vice president with a mixed track record. While he boasts some notable ratings, his analysis of SoFi leaves much to be desired. His valuation fails to account for the company's growth potential, sticking to outdated metrics that don't reflect SoFi's innovative business model. Interestingly, KBW has also shown inconsistencies in its ratings of other financial institutions, raising further doubts about the credibility of its analysis. For instance, in mid-December, KBW maintained a bullish stance on Bank of America, predicting a 24% price increase over the next year. Yet, just a month earlier, the same analysts had issued a more conservative rating, demonstrating a lack of consistency. When it comes to SoFi, their insistence on a low valuation, despite the company's explosive growth potential, highlights a clear bias. Adding to the absurdity is the fact that legacy banks with far lower growth rates are being valued more favorably. Bank of America, for example, trades at a PE multiple of 15 and a PEG ratio nearing 3, which indicates overvaluation. Meanwhile, SoFi's PEG ratio, based on its expected growth, is well below 1, underscoring its potential as an undervalued growth stock. The numbers simply don't add up, and the narrative being pushed by KBW seems more like an attempt to mislead investors than a genuine analysis. This isn't the first time SoFi has faced such challenges. Similar tactics were employed last year, with KBW issuing a sell rating just as the stock was gaining momentum. Despite these hurdles, SoFi has consistently proven its resilience, outperforming expectations and delivering strong results. As we look ahead to the Q4 earnings report, it's clear that the company is on track to continue its impressive growth trajectory. For investors, the current dip in SoFi's stock price represents a potential buying opportunity. The sell rating and the ensuing panic are short-term events that don't reflect the company's long-term fundamentals. With a strong earnings report on the horizon and a clear path for growth in 2025 and beyond, SoFi is well positioned to rebound from this setback. In conclusion, the recent downgrade of SoFi stock is a textbook example of market manipulation. By relying on outdated metrics and flooding the media with negative headlines, short sellers have managed to create panic and suppress the stock price. However, savvy investors who recognize the company's true potential have a chance to capitalize on this temporary dip. As SoFi continues to grow and deliver strong results, the flaws in KBW's analysis will become increasingly apparent. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.